Welcome to the Finance Report. I'm Mallory Hoff alongside David Wilkinson and our guest, John Blanchard. Over the next half hour, we'll discuss preparing for a successful retirement and why so many people in this country are missing the mark.
So here's what's in store. First, we're going to talk about preparing for retirement the right way. Then in 15 and 15, we'll discuss income, taxes, and growth strategies, plus how market volatility can change your outlook for retirement.
Joining us now is Acadiana's retirement strategist, John Blanchard. John is a financial professional with Matthew James Financial Group. He's also a popular radio show host. John, what are the keys to building a truly successful retirement?
Well, the key thing is figuring out, okay, what age do you want to retire, you and your spouse, if you're married? The next thing is how much money do you have or do you need coming in? So we have to look at what's the guaranteed sources of income, and then we need to look at the math and figure out how much additional money you need coming in every month, which from there we can figure out how much money you need to build up and save. And then from there, it's having a strategy that looks at, what's going on with inflation from tax purposes, and then just the amount of money that you need coming in. We need to look at all these different things from a dynamic standpoint to be able to figure out what's the best goal for you.
Yeah.
John, you mentioned income. Why is income planning so critical for a successful retirement?
Well, look, we as Americans have been working all these years to create income, to pay our bills, to feed our kids, to put them through college, to marry off our daughter, those kind of things. But there's a trigger that happens whenever you quit working. You're not making income anymore, so now you need to start receiving income. Mm-hmm. So where you're going to receive it from, and that's the key thing, is we got to figure out, okay, number one, where's that money going to come from? Do you have guaranteed sources of income? Do you have a pension? Do you have Social Security? When you should start taking your Social Security? And then from there, we got to look at where to trigger other income streams that we can manipulate and lower your tax threshold as well.
You just mentioned Social Security and a pension. How often do people think that might be enough to rely on?
Well, look, it depends on your standard of living. Some people think, okay, that's enough money, but we've been seeing all this inflation this year, that becomes a problem where you need additional money coming in. Sometimes people might elect to go get a part-time job so they don't have to withdraw from their investment account. So everybody's in a different situation. The key thing is we got to figure, okay, what's your goal income from your necessities? Okay, then there's the wants. So you have your needs and your wants. So we got to figure out, will your guaranteed sources of income cover all of your needs? And then your extra money that you have invested, that can cover all of your wants and more.
Yeah.
Taxes could very well be a retiree's largest expense during retirement. How can tax planning potentially make a big difference, make a big impact with our income needs?
Well, tax planning is a big thing that we have to look at, and that's one of the first things that we focus on whenever we speak with people regarding their investments, how they're going to, transact different things, because you can manipulate where you're getting money from, not your pension or your social. You can manipulate when you're going to take your Social Security, but then we have to look at where's your money invested, which type of taxable bucket. You have your tax-deferred accounts, which are your IRAs and 401ks. You have your tax-free accounts, which would be your Roth, and then you have your taxable accounts. So this would be a CD at the bank. This would be a joint investment, an individual account. So all these different types of tax buckets, whenever you layer them on top of your pension or Social Security, they cause different types of taxation. So if we can figure out, how much money you can throttle in and out of these accounts every year to basically manipulate the tax code so you can lower your tax bill.
John, let me ask you this. How often do you find people walk into your office for a first visit and you realize very quickly they have spent years completely overlooking taxes?
Yeah, most do, realistically. And, a lot of people have been working with other professionals and I say professionals, other like advisors, or that maybe they've been do-it-yourselfers. So the thing is, just about all of those people have only been focused on the actual investment. They bought something a long time ago and they're holding on to it, and they've been seeing year to date what's been going on. Maybe it's time to move, maybe it's time to pivot. But then they haven't taken taxes into equation, because a lot of people they might fire one financial advisor and go to another, and then that new person will sell everything they have. That's not in an IRA. And what happens is that's a taxable event.
Mm-hmm. Yeah.
So whenever they file the taxes the following year, then they realize, well, I have this big bill that I have to pay in taxes on money they didn't even take. And so those are issues. The other thing is phantom gains. So many Americans are paying taxes on phantom gains, not realizing what it's from. So like our clients don't pay taxes on phantom gains. So it's how to have a tax strategy so you can eliminate phantom gains and eliminate any kind of unnecessary tax or unnecessary higher expense on Medicare Part B and Part D premiums as well.
Some important information, and right there, listening to you speak, it seems retirees need to be active, not passive, which means the time to act is now. Today, exclusively for our Finance Report viewers, John has a great offer for you. Right now, for the first 5 callers, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John to schedule an office meeting, phone call or video call, so he can speak with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to dial, 337-366-8366. That number, 337-366-8366.
And today we're breaking down the retirement preparation process. John, you and I are both old enough to know in life, unfortunately, the unexpected does happen. How can we make sure we're best prepared for those expenses, though?
Well, the key thing is just like whenever you're in your working careers, you want to build an emergency fund.
Yeah.
The key thing, even though you're retired, you should still have an emergency fund. You know, you went from shifting to where if you lost your job, you needed money to cover your expenses, but also if you needed a new roof, you know, going into, you know, being in hurricane season each and every year that we have to deal with. But the other thing is if you need another air conditioner unit or you need a new transmission. Well, in a retirement, those things still happen.
Sure.
You might need to replace your income from a job standpoint, but then you need to have money there for an unexpected medical expense. Maybe you have a child that gets into a bind or another family member, or, you know, like I said earlier, your AC could go out and you need a new transmission, another set of tires. Those events still happen in retirement, so it's still good to have money set aside for that.
John, I want to talk about risk for a moment. When we're in our 30s, our 40s, risk obviously much more tolerable. Let's talk about why it's so important as you approach retirement to really be dialed in on just how much you're taking on.
Yeah, so the key thing, you know, these several years back, last 10, 12 years, a lot of people have been riding this bull market, and it's been exciting. The returns that people have been seeing on their annual statements have been nice. Now, obviously, year to date, it hasn't been looking too good. So the key thing here is, you know, you cannot be swinging for the fence like you have been these last couple of years, because whenever you're working, you're making contributions to your investment account and you're expecting a certain growth return as well. Well, now you're not contributing anymore, and now we're seeing a down market. So those are two things that are becoming an issue. And so the last thing you want to see is, you know, your account value dropping 10, 20, 30% in your retirement, because now you're going to have to lower your goals, limit the amount of spending you have. Everything changes. So the volatility that people have to deal with in retirement is one of the scariest things, because whenever you're withdrawing money on negative years, negative months, maybe a negative decade, that could become an issue, could maybe force you to go back to work. So we have to look at these things and how to, you know, minimize risk as much as possible using the right strategies.
You just touched on it. I do want to talk a little bit more about a big loss and what that really can mean for you if you are in retirement or nearing retirement. I know you've had people come work with you after suffering a big loss while working with someone else. What's the cleanup process like?
Well, we have to look at where you are as far as where your investments are held. So we do a portfolio x-ray to figure out how much risk you're taking, what kind of fees you're paying.
Sure.
And then from there, what kind of tax consequences you have to deal with. Because every dollar you can save in taxes is equally as important as every dollar that you can gain by growth. So we have to look at these things and put everything together to make sure it's going to work properly. Whenever you're looking at how much loss that you're vulnerable to, we have to minimize that as much as possible.
I think a lot of people hear some of this and they're thinking, okay, this is all well and good. I just want to make sure my money can still grow. How do you respond to that?
Well, we just have to look at, number one, where you're at, what's going to be the withdrawal amount that you're taking out per year, because you might be withdrawing too much money every year, and that could be a big problem. Because if you're only growing by a little bit and you're withdrawing a higher percentage than what you're growing by, that's a big problem. But whenever you're taking too much risk to try to get a certain return to be able to pull even more money, then we're having a bigger problem that you're going to run into when we have market downturns like what we're in right now.
John, always really great information. We appreciate it. Coming up on the Finance Report, we'll discuss the stock market and the ups and downs that can occur with your retirement. And up next in 15 in 15, David will put John on the clock.
How have the rules to retirement planning changed?
Well, look, a lot of things have changed. It depends on where you're pulling your money from, how much risk you're taking.
But first, exclusively for our Finance Report viewers, John has a great offer for you. Right now, for the first 5 callers, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John to schedule an office meeting, phone call, or video call so he can speak with you personally and provide you with a roadmap going forward. Again, all of that at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366.
The clock is ticking towards your retirement, so that brings us to 15 and 15. 15 topics in 15 seconds. You ready to go on the clock?
Let's go.
All right, let's do it, man. How much money will you need to retire? According to a survey, more Americans than ever believe the magic number for a successful retirement is $1 million. So, John, is that the magic number for retirement?
Well, it depends. Everybody has a different number. You know, you'd be surprised how many people just need $250,000 to retire. It all depends on where's their guaranteed sources of income. If someone has a very valuable pension, their Social Security is very strong, then that's less money they need to be able to withdraw from another investment account. So it all depends on what your goals, what's your numbers, do you have any debt to pay off whenever you're retired. All those things we have to account for figuring out how much you really need. But the more money you have, the better off you'll be.
No, absolutely. So don't chase a magic number.
No.
Okay, understood. You heard it right there. Question number 2, it's understandable to have some concerns, perhaps even some fears when it comes to using our savings in retirement. So, John, what can people do to spend with confidence?
Well, look, having more money, going off what we had, makes it easier. You know, whenever you're having to pinch pennies, it becomes a problem. Now where we're dealing with a lot of inflation, it's a struggle for a lot of people. We're seeing, every time you go to a restaurant, obviously when you gas up, you're buying groceries, everything's more expensive now. So that's a problem. And the people that are on fixed income, they're struggling the most. But people that are not on fixed income, they're having to withdraw more than what they normally would be. So they're, kind of nervous.
Yeah.
They're not withdrawing 4% of their total nest egg. They might be withdrawing 8%. So that could become a problem in this volatile market that we're in right now.
Yeah, nerves not the way you want to go into retirement. Question number 3, what if I told you 45% of people who do not have an advisor believe the typical cost for one is between 5 and 15% of their assets? Is that number reasonable?
No, not at all. Not at all. That's a lot. That's expensive. Typically, most people's advisors cost them somewhere north of 1% annually of their amount of assets that they have that are investable. But 15%, that's stretch.
Okay, what about even 5% though? The number you just mentioned there, 1% a little bit north of it. If you're paying 5%, start sprinting? Away, other direction.
The thing is, we should have a conversation. And look, there's people that are paying 5% that they don't know that they're paying 5%. Realistically, people might be thinking they're paying 1%.
Wow.
But whenever you add all the internal fees and cost of those particular types of investments that have those kind of charges, you need to run a fee report to really know what you're paying.
And we might have a question on fees coming up. That's a tease, folks. Let's do taxes. A recent survey found that over 30% of every dollar a retiree spends goes to pay taxes. So, John, are we really looking at nearly a third of our money going to Uncle Sam?
Well, just think when it could be a 50% of every dollar. So these are things that we have to look at because most people think when they go into retirement, their taxes are going to be lower because their income's lower. Whenever you have a multitude of different income streams coming in, that causes different types of taxation. So if you just have Social Security, you won't pay taxes. But whenever you overlap that with a pension, withdrawals from your IRA, whenever you're realizing capital gains, whether it's short-term or long-term, you may have dividends, you may have municipal bond income, you might have rental properties. All these different sources of income cause different taxations. And the more money you have coming in, creates another layers of taxes as well. So we have to look at all this because most people going into retirement will have a higher effective tax rate than when they're working.
Yeah, taxes can be a huge expense. And with that in mind, let's ask another tax question. When it comes to income taxes, is it possible to receive retirement income from our life savings without having to pay those income taxes?
It is, but it also depends. So if you're in a situation where you have Social Security coming in at some point, you can ladder your investment income. So the amount of money maybe coming from an IRA or the amount of money that you can realize annually as a long-term capital gain. By design, through tax management, you can set up your income to where you can even pay a 0% tax rate, but you have to plan to do so.
Sure.
You might have to put yourself in a situation for several years planning to do this by paying taxes to move and asset shift money over from a tax-deferred account to a tax-free account. So then there you can have money coming in from Social that you won't have to pay taxes on, a certain amount of money that you can withdraw from an IRA that won't be taxable, and then you have other money that you can realize as a long-term capital gain that won't be taxable, and then you have tax-free income coming in from like a Roth account. So there is structure, it's just you have to plan to do so.
Understood. You know what, this segment is called 15 and 15. We had to go about a minute and a half right there to hit all the important things on taxes. It's great information. Question number 6. Obviously, as we approach retirement, our thinking can change. So is it more important for a retiree to focus on growth or protecting their assets?
Well, we need to look at a combination. You know, we do want to grow because the thing is you're going to be using that money. But the thing is we also have to look at protecting that asset for the long term. You know, with the volatility that we've been dealing with since COVID is very alarming. And people have been, you know, numb to 2008, what happened there. And they've been seeing this bull run, which has been exciting and these great returns. But the thing is, whenever you're chasing a return, you know, there's a cost, and then the risk of the market that we're dealing with now becomes a problem. So the key thing is to measure where you're at, seeing if you have any vulnerability with these investments, and how can you course correct using safer strategies.
Look under the hood. Question number 7, who doesn't love guaranteed money? Annuities are an investment that can do that for your income. But John, why do you believe so many people are hesitant to buy one?
Well, it's having an understanding, you know, if you should use that or not. You know, I don't favor those type of vehicles for guaranteed income purposes.
Okay.
Now, a lot of people buy them, but I have a problem with it because you can't pivot. You know, you might be able to get guaranteed income from those things, but the key thing, there's other tools that you can use and other strategies to get guaranteed income without having to lock up and tie your money into annuity for the long term.
All right, a lot of great information right there. And here's great news for you. We're pausing the clock. We're going to get hydrated for the second half. Today, exclusively for our Finance Report viewers, John has a great offer for you. Right now, for the first 5 callers, he's offering a no charge, no obligation, full-blown retirement income plan just for you. This will allow John to schedule an office meeting, phone call or video call, so he can speak with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. That number, 337-366-8366. Back on the clock we go. Topic number 8 of 15 and 15. We've worked decades to get to retirement. We want to travel, see the world, do fun things with our families. So John, how can we maximize our lifestyle goals in retirement?
Well, the key thing is looking at, okay, where do you want to go? How much is that going to cost you? And look, there's going to be things that come up and other expenses that we need to see. That we're gonna have to put out money for. So the key thing is looking at, okay, if you plan on taking vacations, whether you have a big trip over the Pacific or the Atlantic, you know, how much is that going to cost? What's the duration of the time there? You know, are you going to be at a 5-star resort or something? You know, less than that. Everything has an expense to it. So it's a matter of earmarking money for those type of events whenever you take them. Now, look, some people may have a goal of buying an RV or maybe do like some kind of like a ride share RV type thing where that's its own expense itself. But what we have to look at is, you know, how many times are you going to be making these trips? What's the expense, you know, for that? So, you know, you might be doing things once a month. You might be doing things twice a year. You might do something every other year. So we have to earmark money for those events, but earmark it for tax efficient withdrawals to use that money. Because whenever you're maybe making a purchase, a lot of people come to us and they want to go and maybe buy an RV and pull money out of their IRA. Well, because they don't want a loan on it, which I understand the fact that you don't want a loan. But, you know, it's all about OPM. You know what that means?
I don't.
Other people's money. So the thing is, it's using the banking system to leverage. Whenever you can borrow money at a lower rate, that might be your better route, because pulling money out, especially if you're pulling out a couple $100,000 out of your IRA to buy an RV, if that's what you're doing, you know, you're paying 22 and 24% federal tax on top of the state tax. So you have to calculate if you're going to go the bank route, borrow money, okay, what's your interest cost versus how much you're going to pay in taxes. So we have to calculate these things to see which is the better route. But the ideal thing to do is whatever your goal is from a travel standpoint, a vacation standpoint, earmarking money, but earmark money tax efficiently.
All right, once again, passionate answer from this man, because that went much longer than 15 seconds, but it is your show. Question number 9, fees. I've heard them compared to termites just eating away at your retirement. You touched on fees a little bit earlier in this segment, but what exactly can happen in one's retirement plan if they're unaware of the fees they're paying?
Well, so fees do erode growth over time, but they also erode your nest egg as you're withdrawing money. And so when we're seeing a triple threat right now, when we're dealing with inflation, we're dealing with negative volatile markets, and then you add high fees on top of that, that becomes even a bigger problem. So it's good to understand how much you're paying. If you go to the grocery store this evening and you go pick up a gallon of milk, and it's along with other things in your grocery basket, but that gallon of milk is $45, or are you going to ask the person that's actually ringing up your groceries to stop because you know it's at the wrong price? or you're going to just let it go through. The thing is, you need to know exactly how much you're paying. Somebody might tell you that they're charging you 1%.
Okay.
You have to look at what kind of load fees you're paying. What is the expense ratios annually? 12B1 fees. Do you have mortality charges? What other rider fees do you have? So we want to look at all these things to making sure that you're not overpaying.
All right, 401ks, lots of people have them, rely on them for income, but how common is it for parts of someone's 401k to be underperforming?
Well, we could see this a lot because a lot of people may just pick the red or green or blue, option, but not really understanding what's going on there. But over the years, a lot of 401ks have been overloaded with bonds. And so that's an issue because people think bonds is safety. Well, bonds are down and they expect to be down for the next 3 years.
On the note of that, once upon a time, pensions were standard. You collected Social Security, and a few mutual funds and bonds carried you to retirement. But John, how have the rules to retirement planning changed?
Well, look, a lot of things have changed. It depends on where you're pulling your money from, how much risk you're taking. The other thing is dealing with volatility and taxes. So everything has changed. We just have to look at what assortment of investments you have, how much money you need, and then how to reconfigure that strategy.
Question number 12, we discussed that really being ready for retirement is both a mental and a financial question. So John, how many people really know if they're really ready for retirement?
Well, I mean, a lot of people look at, okay, they're trying to get a certain number, but also they're trying to get to a certain age. Maybe they were trying to wait till they start collecting Social Security. But the thing is, what are you going to do with your time? We focus on so many years of making income and then transition into what? Most people don't know, they don't have a new identity, whenever they retire. So maybe focus on making an impact in your community.
All right, we have talked about how taxes might be the largest expense in retirement for people. Long-term care, that could give it a run for its money. So what can people do to prepare for that without having to buy some huge insurance policy?
Well, it's earmarking money, using maybe an HSA, building out an HSA the correct way, growing an HSA, maybe using an HSA as an investment vehicle that might own an LLC that can own, alternative assets. There's a lot of different things that you can do, strategies where it's tax efficient, but also can fund, in that need if you end up going that route.
As you've touched on, a lot of different strategies are out there for people, a lot of tools to use inside that box to prepare for a successful retirement. Buy and hold, is that a strategy that still applies today?
That's an issue there because a lot of people have been sold on buying and hold long term. The market's going to come back, it always does. It's an issue because we're seeing account values drowning right now. And there's another approach that you can go that's more dynamic, having a strategic approach to investing to where when you should hold and when you should go.
Understood. Last question, number 15. This one's gained a lot of steam over recent months, years. Cryptocurrency. Is that something retirees should be putting all their money into?
Absolutely not.
Okay, absolutely not. That's it?
That's it.
You're not going to give me 15 seconds on this one?
No, it's a good answer.
All right, that is a good answer. You heard it right there, folks. A lot of great information. And for that reason, today, exclusively for our Finance Report viewers, John has a great offer for you. Right now, for the first 5 callers, he's offering a no-charge, no-obligation, full-blown income plan just for you. This will allow John to schedule an office meeting, phone call or video call, so he can speak with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. That's 337-366-8366.
And we're going to take a little bit of a trip back in time for a moment now to 2008. John, to say that was a trying time in this country obviously would be an understatement. What I want to know is this: have we learned from this period in time?
Well, look, most people haven't. A lot of people have had 2008 amnesia when they were there, investing actually since COVID. And we've had, different times in our history over the last 2 decades where we saw a lot of volatility from 2000 to the end of 2002. We obviously what we saw the big market drop in 2008, that 07, 09 time period. And then when COVID happened, the market was actually more overpriced then than when it was before the dot-com bust. But it was a flash crash. We had a black swan event. And then the market fell, the government came in, put stimulus money in people's pockets, corporate bonds were being issued at low rates, companies were buying back their stock, the market climbed at an all-time high. And then, it's where we're at today. There's a lot of changes in the market, but a lot of people haven't, really learned from the past, and now it's time to really course correct.
Okay, so speaking of which, obviously people got very comfortable during the longest bull market run in history. Let me ask you this: how hard is it to convince someone at times it's time to go? It's time to make your move?
Well, so that's the thing is a lot of people look at this thinking,
Yeah.
okay, it's going to keep on coming.
Sure.
Because they've been told for so many years that the market's going to come back, it always does. People see these numbers are going to be higher in the future. Well, the thing is, if you invest like Warren Buffett or other very successful money managers, is what can you do whenever data is telling you, look, it's time to probably maybe get off the table and keep your cash on the side, because what we're seeing now year to date has been pretty rough.
John, always a pleasure and great information, which means the time to act is now. Right now, exclusively for our Finance Report viewers, John has a great offer for you. Right now, for the first 5 callers, he's offering a no charge, no obligation, full-blown retirement income plan just for you. This will allow John to schedule an office meeting, phone call, or video call so he can speak with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366.
Before we go today, let's recap.
Yeah, when it comes to preparing for a successful retirement, your tax strategy matters, right?
Yeah, I mean, that's the biggest thing that we have to look at. And really, that's the first thing that you should look at is how to build your investment structure, your income structure, using tax efficiency.
Yeah.
On the note of income, why is it so important in your mind to create multiple sources of dependable, sustainable income?
Well, it's good to be diversified, really good to be diversified, because the thing is, it's you never know when one, you have to stop taking income from because of a market condition, which we're seeing a lot of market conditions right now. But the more diversified you can be, the better structure, the better sound your investment income, your strategy, the way you're going to live is going to be.
So when it comes to risk and protection, what should our takeaway be?
Well, we just have to look at what's going on with the market. A lot of people are trying to take more risk to try to get income to try to combat inflation. The thing is, it's looking at all these different metrics, from our point of view, not something that you really have to do as a consumer. But the key thing is for us to manage that money, manage that risk to be able to get what you need, every month or yearly as you need to, change your lifestyle or increase your lifestyle habits.
Yeah.
John, you've mentioned several times when it comes to the market, there's that old philosophy of just sit tight, wait for it, it's going to come back. Yeah. With everything that's going on in this world, why is it so critical for retirees not to be passive but active?
Well, look, we have a lot of different things going on. What's happening with the Fed? What's happening with the stock market? What's happening with inflation? What's happening with the bond market? The housing market, the student loan, debt crisis, the credit card debt crisis. There's a lot of issues, supply and demand, constraints. So there's a lot of things going on. Just, sitting tight and hoping it will come back is not really a solution. Being dynamic, being active, and to where you can pivot in the right direction when it's time is the key thing.
And John, all of this being said today, you have something very special for our viewers watching at home.
Yeah, I do. I'm really excited about this. For the first 5 callers, I'd like to invite you into the office where our team will sit down with you and personally help you create your very own retirement income plan. Mallory, David will do this even on a complimentary basis.
And that really is an opportunity that should not be missed. Once again, for you at home, exclusively for our Finance Report viewers, John has a great offer. Right now, for the first 5 callers, John is offering a complimentary full-blown retirement income plan just for you.
This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call, 337-366-8366. That number, 337-366-8366. For all of us at the Finance Report, thank you for watching.
And we'll see you back here next time.